Please, sir, may I have some more? More stimulus, more bond yield, and more vaccine. Spring is in the air. This is Bloomberg Wall Street Week. I'm David Westin. This week, contributors Larry Summers of Harvard, Gillian Tett of the Financial Times.
Is the Fed doing enough to make investors understand that there's a two-way risk right now around prices and rates?
And Stephanie Flanders of Bloomberg. Ruchir Sharma of Morgan Stanley.
Capitalism, I think, is being undermined when you keep on doing these kind of interventions.
Katherine Baicker of Chicago's Harris School of Public Policy. Peter Kraus of Aperture.
To think that you're going to stay at this level of yield for the next 5 years is just irrational.
And Amy Schulman of Polaris Partners. This week, Wall Street almost breathed a sigh of relief as Congress moved forward on yet another massive stimulus bill.
We need Congress to pass My American Rescue Plan that deals with the immediate crisis, the urgency.
Fed Chair Jay Powell promised he'd keep monetary policy easy for a good long time to come.
There's a long way to go, and monetary policy is accommodative, and it needs to continue to be accommodative. Expect us to move carefully and patiently and with a lot of advance warning.
And Johnson & Johnson moved to put another vaccine into people's arms, one that requires only one shot instead of two. But then a winter chill went back through the markets as the yield on the 10-year jumped, as did commodities prices, while tech took it on the chin, raising questions about whether better times were ahead or rising prices and tightening financial conditions. So for the week overall, we had something of a wild ride. Tech stocks rebounded a bit on Friday, but the NASDAQ 100 still posted its worst week since October. The S&P 500 had its worst week in a month. And after spiking up and getting everybody excited, the 10-year yield settled back down just a bit, ending up just over 140 basis points. Joining us now is former Treasury Secretary and Wall Street Week special contributor Larry Summers to bring this all into perspective. So, Larry, thank you so much for being here. Let's start with the stimulus. We're on the cusp of getting more stimulus. Looks like the House is certainly going to approve it. Then we're going to have the Senate, $1.9 trillion. Whether you like it or not, certainly business leaders like it. We got a letter out this week from a lot of business leaders saying this is a great idea. The polls indicate the masses like it. If business leaders and masses like it, can they be wrong?
Business leaders have been wrong a lot in history, and they're right that stimulus is a good idea. Many of the business leaders who signed that letter have also been saying that the level of the stimulus is risky, and so we need stimulus, but not all of this stimulus. I think that it's better to have stimulus than not to have stimulus, but I think there's enormous risk we are running that with all that we're doing, there's not going to be enough room for the public investments that are vitally important. And perhaps even more importantly, or as importantly, we're going to set ourselves up for inflation concerns. And then we're either going to have inflation or we're going to have a collision between fiscal and monetary policy to contain inflation of a kind that doesn't usually end well. It's not hard to see the internal contradictions. An economy with 3% GDP gap, getting 9% GDP fiscal stimulus is one way to see it. An economy with a net private savings rate that's 7-8%, dealing with an 18% of GDP budget deficit is another way to see it. Yes, there's fundamental public investments we need to make. Yes, there's a need for relief from COVID. And God knows we need to do things about inequality. But I think the scale of what we are doing, a nearly $2 trillion savings overhang, a 14% of GDP, $2.8 trillion of fiscal stimulus, the Fed with its foot on the accelerator to the floor and saying that it's going to stay that way for a very long time and be pulled up without warning. I don't think it's amazing that we've seen more turbulence in financial markets. Some of that's got to do with the micromechanics of those financial markets, but some of it's got to do with the broader environment.
Well, let's go to that point just exactly, because after that dramatic spike up in the 10-year, some people said it was more technical than something more fundamental. We heard from Jay Powell, the chairman of the Fed this week, saying, don't worry about this. We're fine. Insofar as the yield goes up, it's really because it's a vote in the confidence in the future of the economy. Is that right? Is that what we're seeing as a vote of confidence in the future economy?
We saw a lot of things. We saw tech stocks go way down. That doesn't seem like a vote of confidence in the future of the economy. We saw commodity prices go way up. That doesn't seem like a vote of confidence in the future of the economy. We saw credit spreads widen. That doesn't seem like a vote of confidence in the future of the economy. So I don't think that this all has to do with confidence. It's certainly true that with cyclical expansion, you could expect to see some normalization of interest rates, but we've seen a move that's as large in the last month as in any month in years. Same thing in the last quarter. I don't think anybody should be slave to the markets. I don't think anyone should be certain of any kind of inflation forecast. But I think on risk analysis grounds, we certainly shouldn't be dismissive of the risks of inflation at this point. We certainly shouldn't be dismissive of the risks of an overheat in the economy at this point. And I'm concerned that we're having a dynamic that is in many ways reminiscent of the 1960s, when conflicting demands, great social concern led well-intentioned officials, terribly dedicated, serious, and thoughtful officials, to be too optimistic about what the economy could handle and let things get away from them. And inflation went from 2% in 1966 to 6% in 1969 before there were any supply shocks. And it seems to me that we're at risk of making that kind of mistake again.
Well, Larry, if we are on something of a sugar high right now, how are we ever going to come down off of it? Let me put it a different way. If Jay Powell is reassuring us so we don't have a temper tantrum, are we going to have a temper tantrum sooner or later, no matter what?
You know, anytime you say anything is sure to happen no matter what, I think you're on very shaky ground, David. So I'm not going to say that. I think there is a tension between Chairman Powell, and look, he's got an enormously difficult job, and we're lucky that he is there. But I think there is a tension between Chairman Powell's statements that there's no way rates will be raised without large amounts of warning, on the one hand, and on the other hand, that it's a long way off. And on the other hand, we're concerned and will do what's necessary to maintain price stability. Because while it's certainly not time to be raising rates or even cutting off QE right now, I think there's a real possibility that within the year, we're going to be dealing with the most serious incipient inflation problem that we have faced in the last 40 years. Now, that sounds very dramatic. And in part, the reason I say it is because we haven't really faced very serious inflation problems in the last 40 years. But I do think that we need very much to have a sense of two-sided risk. And right now, I think the risks of inflation, of financial bubbles, of economic overheating, of excessive euphoria in markets, I think those risks are much greater than the risks of deflation, of insufficient aggregate demand. That could change, but right now, I think we are still fighting the last war in the rhetoric of policymakers. We're still fighting the war against a COVID-caused shortage of demand when the greater threat is a war against COVID, classic wartime inflation pressure. And that's, I think, the disconnect between reality and a certain amount of the policy thinking that's underway.
Okay, so Larry, we always finish with a lightning round. Summers says this time we may have room only for one of them. But let me ask you specifically. President Biden this week said he's really going to take a hard look at our supply chain system. Are we going to have substantial differences in our supply chains a year from now?
I think we'll be more secure in some key areas. I hope that's what we'll focus on. And this isn't going to become an excuse for a lot of protectionism. That's a real risk in my view.
Okay, let me sneak one more in. Janet Yellen says that we are going to be taking a look at corporate tax rates as well as capital gains 2 years from now. Will they be different?
I guess yes. They certainly corporate tax rates should go up. The business community was confident that it would think it was fantastic if rates were 25%, and they'd be happy if they were 27 or 28%, and Donald Trump reduced them to 21. That's a very poor use of resources. Right. Certainly in terms of capital gains, the loophole for estates, so-called the absence of constructive realization at death, we should get rid of that.
Larry Summers, thank you so much, our special contributor. Coming up, we go through the weekend markets with our roundtable of contributor Gillian Tett from the Financial Times and Peter Kraus of Aperture.
It's also recognition that some of the tech stocks might have got way overhyped.
There are also tech stocks that are actually quite innovative.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. You can't talk about the markets this week without talking about the back and forth between the 10-year yield on the one hand and equities on the other, or for that matter, about the real tug of war being played between the stay-at-home stocks, things like the tech stocks on the one hand, and on the other hand, the let's get back to work stocks like financials and like energy. And here to take us through that, we have a very special roundtable. We have Gillian Tett. She is chair of the editorial board at the Financial Times, as well as editor-at-large for the U.S. for the Financial Times. And we have Peter Kraus. He is chairman and CEO of Aperture. Welcome to both of you. Great to have you here. Gillian, I want to start with you because you, in my experience, were one of the early ones talking about inflation. And people are coming around to your view that at least we should be talking about it, even if it's not here. And let me start with the most basic question, I think, which is, what's the difference between reflation and inflation? We had Chair Jay Powell this week say, no, this is just healthy because we're just getting back to normal in the economy. When do we get worried about it?
Well, the point is, David, that actually the difference between reflation and inflation really is in the eye of the beholder. It's when prices go up. And I am not arguing that prices going up is a bad thing. Absolutely not. It's exactly what you expect to see when you have a recovery. What is a bad thing, though, is to have a market completely positioned around the presumption that either prices will never go up or that the Federal Reserve will never raise rates. And that is essentially where we've been in the last few years. Now, you're starting to see some investors say, well, actually, we should start preparing for a regime shift. But to my mind, the question is the Fed doing enough to make investors understand that there's a two-way risk right now around prices and rates, or is it still lulling people into this false sense of security that rates will stay low forever? And my concern is that it is.
Well, Peter, certainly nothing in Jay Powell's testimony in Congress this week would really avoid that lulling into a sense that there's not two-way risk. But are the equity markets pricing this in at all at this point?
I think the equity markets are beginning to take notice of the principles that Gillian laid out. I actually think she laid it out perfectly. We need a healthy environment, which means that prices go up. It doesn't mean they go up at 4 or 5% a year, but it does mean they go up at 2 or 3% a year. That's a healthy environment. we haven't actually been in that kind of a price regime for quite some time. And real interest rates, which are key to the actual economic consequences of the marketplace, have been negative. They're negative in Europe and they're negative in the United States. And the Fed and the central banks around the world have, as Gillian points out, for the last 3, 4, even 5 years, been very aggressive at injecting liquidity into the system, forestalling any potential decrease, and creating lots of interest in negative real rates. And so the market has become accustomed to that as a reality. And when the market becomes accustomed to that as a reality, it starts to overpay for securities that do well in that environment, and it underpays for securities that do poorly in that environment. And if that's persistent, you get a wide gap in valuation. And that is where we are coming into this actually last 2 or 3 months, where rates have gone 40, 50, even 60 basis points higher. And the volatility we see in the market right now is the market trying to reconcile the points that Gillian made.
So, Peter, there was a time when we talked about basically 60-40 blend in your investment decisions. At this point, does it make any sense to be in fixed income at all?
Really good question. Fixed income is as expensive as it has been in probably 30 years. You know, I'm a little bit of a historian or economic historian. I like looking at the history. 1982, 1983, inflation, which was real inflation, you know, was 7, 8, 9%. And the 10-year bonds were at 13, 14%. And since then, we've done nothing but see a reduction in bond yields and increases in prices for 37 years. So to think that you're going to stay at this level of yield for the next 5 years is just irrational. Doesn't make sense. So if that's the case and you're an investor, not a trader, but you're an investor over the next 3 or 4 years, you have to be thinking that yields are going to rise. You have to be thinking that duration is expensive. And so if duration is expensive, why would you hold as much of it as you normally would? The other side of that, of course, is equities will outperform bonds. By the way, in that 30-year time period, equities underperformed 10-year bonds, which is highly unusual. That's not going to be the case going forward. Now, I'm not telling you that equities are going to earn 15%, but I am saying that equities are going to outperform bonds. So one could argue that 60-40 is probably a little conservative, and that maybe 70-30 would make more sense.
So, Gillian, it sounds like equities might be the place to look, at least initially, but it depends on which equities. Another thing we saw this week was really what looked to be perhaps a rotation away from tech, which have been doing so terribly well, and into some other places like energy and financials, presumably because of the prospect of our returning back into the marketplace. Is that a rotation that will continue, and how big could it get?
Well, I think the rotation is going to be significant for some time. You know, I'm not like Peter, paid to give us, investment advice or precise portfolio allocation ideas. However, I think one of the things that's going on at the moment, apart from this recognition that at some point the economy will reopen and there is a chance of, quite a sharp rebound, at least initially, is also recognition that some of the tech stocks might have got way overhyped. Because yes, we are seeing a really quite remarkable tectonic shift in terms of our reliance on digital platforms, but we're also seeing a world where there could be regulatory clampdowns and where much of the exuberance around tech stocks have probably got pretty bubbly.
So, Peter, over the medium term, not the immediate, as you said, we're not traders, we're investors, but over the medium term, where do you think that there might be bargains left in equities?
So I think that I would give you a little bit of a nuanced commentary on technology. So there are definitely, to Gillian's point, there are definitely technology stocks that are overvalued because in the work from home, high amounts of liquidity, negative interest rates, investors have valued long-term growth with very low discount rates and bid up the multiples. But there are also tech stocks that are actually quite innovative and whose earnings are actually going to grow because their market shares are going to grow dramatically. And those tech stocks, even in a period of time when tech is actually going to underperform, will do well. So finding the innovative tech stocks, and there's plenty of innovation going on, because one of the things that COVID has created and the pandemic has created is real changes in the way that businesses prosecute their model, their business model. And those changes are creating dramatic changes in market share. So one thing to be careful about is just don't throw the baby out with the bathwater. There are innovative tech stocks that are going to be very attractive to own. To your point, David, that what is the undervalued area of the market? Well, the clear undervalued area of the market are the quality stocks, which haven't participated in the reflation/recovery. There are plenty of strong quality stocks that have strong growth that now people will start to look at as the economy starts to come back and the global economy recovers. That's a place where there's actually undervalue. You wouldn't think it. You'd think, well, let's look at the bombed out stocks. Actually, the bombed out stocks have done pretty well over the last 3 or 4 months. But the quality stocks nobody sort of looked at because, at the end of the day, well, they're just sort of normal quality stocks. But those quality stocks have big market shares, strong brands, and as the economy recovers, they're going to do pretty well.
Okay, many thanks to our terrific roundtable of Gillian Tett from the Financial Times and Peter Kraus from Aperture. Coming up, we take a look at the week ahead on global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It's time now to take a look at what we're watching in the week ahead on global Wall Street.
David, next week marks the start of China's National People's Congress. The budget and plans for the economy will be released on Friday, but markets don't expect policymakers will set a growth target for a second year running. From South Korea, the government is to reveal the size of another extra budget, which could put upward pressure on yields and prompt the BOK to step up bond buying. The RBA has also sought to rein in borrowing costs as markets reprice reflation and tightening bets. The Australian Central Bank is up to bat next week with a policy decision. Ditto for Malaysia. Danny?
Thanks, Sophie. In the coming week, the ECB is going to be in focus. They've already expressed some support should bond yields continue to move higher, but will they do more to support markets? On the 3rd, we also get the UK budget announcement. The government is expected to continue support, but warn that higher taxes are on the horizon to help fill the hole in public financing. Romain?
All right, thank you, Danny. Investors this weekend will get a chance to parse Warren Buffett's annual letter to shareholders that accompanies Berkshire Hathaway's annual report. A hodgepodge of events in the Federal Reserve space. We're going to hear from at least 5 regional Fed presidents this week, including the head of the San Francisco Fed and the New York Fed. Elsewhere, commodities will be in focus. The CERAWeek Energy Conference kicks off on Monday. ExxonMobil is hosting its Investor Day on Wednesday, and the OPEC Plus ministers are scheduled to meet on Thursday. On the corporate earnings front, we do expect reports from Kohl's, Target, Nordstrom, Broadcom, and Kroger. And on Friday, we're going to get that monthly U.S. employment data. This will be the February numbers, and economists are expecting a gain of about 145,000 non-farm jobs. David?
Thanks to Sophie, Danny, and Romain. Coming up, the unintended consequences of all that stimulus. Are we suppressing innovation and productivity? From Ruchir Sharma, Morgan Stanley Investment Management Chief Global Strategist.
The number of zombie companies is going up. And as far as existing companies are concerned, we have rarely had so much monopoly power as we have now.
This is Wall Street Week on Bloomberg. Easy money has been fueling a borrowing binge that might be here to stay, as Fed Chair Jay Powell more or less promised this week in his testimony on Capitol Hill.
We want inflation expectations to be anchored right at 2% and not somewhat below 2%. We are committed to using our tools to achieving that, purchasing assets at least at the current pace until we see substantial further progress toward our goals.
Even the dovish Powell has to admit that the Fed's policies, combined with even more stimulus on the way and vaccines as well, could move inflation up.
I don't think the right question is whether this package would overheat the economy. I think if it were passed as written, it would overheat the economy.
But it's not just inflation that could be an unintended consequence of all that stimulus. Those rock bottom interest rates also promote so-called zombie companies, firms that don't generate enough income to pay interest on their debt. Those underperforming companies have borrowed $140 billion despite credit ratings below investment grade.
Borrowing is cheap. Money is really kind of not an object, amazingly, in all of this stuff.
These walking dead companies include many we all know, like Macy's and Carnival and ExxonMobil.
They're soaking up capital, and that slows down innovation because the natural process of capitalism, which is like forest fires in nature, you clear out the dead wood in order for new growth to emerge, isn't happening.
All 4 major U.S. airlines became zombies in 2020 after the lockdowns forced them to limit or shut down their operations.
It's not just obviously air travel, it's the hotels, it's the theme parks, it's the casinos, it's the cruise lines. They're all such big contributors. Our industry broadly is the single biggest contributor to overall GDP in our nation.
And it's not just that these zombies may be living past their useful life. It's the opportunity cost of their consuming talent and capital that could be put to more productive uses.
Basically, when you have all these zombie companies, first of all, they soak up a lot of talent. It's got engineers kind of sitting around. And at the same time, they soak up a lot of capital, and it leaves less room for startups.
One of the first to see what all that stimulus may be doing to our economy is Ruchir Sharma, Morgan Stanley Investment Management Chief Global Strategist and author of 10 Rules of Successful Nations, who says the health of our free enterprise system itself may be at issue.
I think the big issue here is this, David, which is that capitalism, I think, is being undermined when you keep on doing these kind of interventions. So therefore, what you see here is a zombification of capitalism in a way. And there's one statistic which highlights this. The number of zombie companies, let's say in the United States today, is 20%, which means 20% of all listed companies in the United States have not earned enough profit to cover their interest expense for 3 years in a row. This number in the 1980s was a mere 2%. So I think that this is the entire problem today with the way we think about stimulus and what the effects are. That the conventional wisdom and the consensus is that as long as you don't have inflation, there is really no downside to having constant intervention in the markets and to having all this stimulus, because people are trained to think that inflation is what really should come through as a negative consequence. And the point that I've been making is that there are many insidious consequences of this constant intervention and always supporting the markets. And one of them is the fact that you have a rise in zombie companies, which is why I think that productivity growth around the world and including in the United States has been so weak over the last few years.
So that's a critical point, productivity, ultimately, in terms of really healthy growth. Have we essentially suspended creative destruction, Schumpeter's creative destruction? Because I think a lot of increase in productivity has thought to become from creative destruction.
Yeah, because we're seeing it from both sides. Look at what's going on, which is that the number of new startups, that's declining. The number of zombie companies is going up. And as far as existing companies are concerned, we have rarely had so much monopoly power as we have now. So this combination tells you that there's something wrong with creative destruction. Now, not all is lost, but this is being undermined over time. And I think that these consequences of stimulus and nobody is too small or even big to fail, I think that this is what the consequences are, which are less appreciated, because most people appreciate the consequences when there's an apparent crisis or if there's some big upsurge in inflation. But what's happening beneath the hood, when you look at productivity and why is productivity declining, I think that these reasons are being dramatically underestimated.
Connect up monopoly power on the one hand with what you're describing here with keeping alive companies that otherwise might fail. Why does the one lead to the other? Is it because money is so cheap so people could afford to borrow money to buy other companies, or is it something else?
Absolutely. You've hit the nail on the head, which is that a lot of academic work here has been done to show that the larger companies get larger because they have access to cheap finance and they're able to make acquisitions. At the other end of the spectrum, you have zombie companies that they're able to stay alive because they keep getting easy finance. So what gets squeezed are people in the middle and firms in the middle. And also it keeps out new startups from coming. So I do think that eventually creative destruction comes back, but it gets delayed a lot because of this process. And this undermines productivity, which at the end is the key to sustainable growth. You can do the stimulus, you'll get a big sugar rush, but the key to sustainable growth is productivity. And there just isn't enough focus on that.
What's the exit strategy? I mean, in 2008, we thought we really needed to have a lot of stimulus because we really had a huge financial crisis. And now, 2020, we have the pandemic. It may be a good and sufficient reason to have the stimulus, but is there an exit strategy? And let me put it a different way. Given how much people and particularly companies, have leveraged up, are we essentially too indebted to fail at this point instead of too big to fail?
Yes, that's very true. So there is no real exit strategy because what the policymakers are doing just now is that they're going further down the road. Even though an economic recovery has begun, unemployment rates are falling, we are still talking about how to do more stimulus because interest rates are so low.
Certainly we're seeing equities fully valued, maybe more than fully valued. What about some of the one-offs, things like cryptocurrencies? Is that being reflected in Bitcoin? Is there just so much money sloshing around the system because of monetary and fiscal support that we're going to get the Bitcoins of this world, even if there are no fundamentals that support it?
Yeah, there's one statistic which really sticks out for me. More than 20% of all the dollars that are in circulation in the world today were printed just last year. That's the kind of monetary reflation that we have done. 20% of all the dollars in circulation were printed just last year. So now there's bound to be some consequence of that. And that's really what we're seeing as far as the Bitcoin is concerned, that there are people who are growing growing more wary of this fiat system. And so therefore they're flocking to Bitcoin because the one advantage that Bitcoin has is that its supply is finite. And so therefore we are seeing this rush to Bitcoin because there's such a huge supply of dollars. Other central banks are also following suit. And on the other hand, you have a finite supply of Bitcoin. And a lot of the millennials in particular understand that much better in terms of the Bitcoin market than this do, let's say, gold. So therefore, Bitcoin, I think, has emerged as the new gold, the appeal of a new store of value as a consequence of this incredible monetary reflation that we have seen from central banks.
So, Ruchir, we've been talking about the massive infusion of liquidity in the market, both fiscal and monetary. Let me ask you the provocative question, and that is, given where we are, the role of the government, and that's not just the United States, as you've pointed out, it's also true in Europe, it's true in Japan, the role of the government in the economy, which is increasing, are we in danger of turning into a form of China? We've criticized China for many years for their state-owned enterprise, the extent to which their state control of the economy. Are we in danger of turning into a version of that?
There could be some convergence, but to China's credit, there's one thing I'll say, that China's success over the last 40 years has been that the role of the state has systematically gone down in China. So yeah, you have the state in the background, but the role of the private sector in China has increased a lot. What is it that helped China negotiate this incredible debt bubble that they had built over the last few years? It's the rise of the tech giants in China, all in the private sector. So yeah, I think that the government's there lurking in the background, but I think that we don't quite appreciate how much the private sector in China has contributed to the growth model. But yeah, I think you may have a point here, which is that China started from a very state-heavy model, and that has gone down over time, even though the state is still there. But in the Western world, as you're saying, that we started from a very private sector-oriented model with more and more government intervention that we are seeing there. So there could be a convergence here in the economic models we have in China and we have in the Western world.
That was Rashir Sharma of Morgan Stanley. Coming up, what is it going to take to get us all out of our houses and back on the economic road again? In Europe, from contributor Stephanie Flanders of Bloomberg, and in the United States, from Katherine Baicker of Chicago's Harris School of Public Policy.
That last mile of the vaccine is very hard for a lot of localities to manage.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. This week, there was a sea change in talk about the pandemic. It's still very much with us. The United States marked the tragic milestone of 500,000 people dead. And yet there was hope, with numbers coming down again and vaccines ramping up, which made us think about what reopening all of our economies just might look like, both in Europe and in the United States. So we asked our contributor Stephanie Flanders, Senior Executive Editor for Economics for Bloomberg, what that reopening could look like from her side of the Atlantic.
The Prime Minister was able to lay out his roadmap, and for the first time, people were starting to believe some of the predictions that he had and the landmarks that he was expecting in terms of opening up the economy, because the government has been so successful in following through on its vaccination rollout, and really, as we know, well ahead of many developed countries, including most of Europe, in getting, I think, over a quarter of the population now has had the first dose. So that gives them a sort of spring in its step, and actually a possibility of opening up a little bit, getting people back to school certainly in the next few weeks. But there's a very slow pace after that of reopening, which has certainly been disappointing to the retail industry and hospitality industry. They're taking it very slow, and really not a full reopening until the beginning of the summer. So good for the economy relative to some parts of Europe, but slower than many people would like.
We'll talk about the relative to some parts of Europe. How does it look over in continental Europe to you right now? Are they having more trouble getting ahead of the virus?
Well, they are certainly. They've been battling a second or third wave, depending on which country and how you measure it, for some months now. It's fair to say they didn't have the intensive spike that the UK saw towards the turn of the year, which led to that big third lockdown here in the UK. Certain countries have managed to avoid those full lockdowns, but Germany, France, Italy, all kind of on the edge of perhaps needing to increase the controls on the economy, and not much of a sign that they're going to be able to reopen on anything like the same timetable as the UK, given the very slow pace of vaccine rollout.
So on this side of the Atlantic, we have this further stimulus package we're expecting, certainly the House of Representatives to pass this week, but we may be going on to the Senate, $1.9 trillion. It's going to be bring it to like $4 trillion. You don't have quite that much fiscal stimulus. There's been a report in the Bloomberg, actually, you may be a full year behind us in terms of getting your economy back to where it was before.
Yeah, that was a great thing, actually, because we were looking at some of the economic forecasts and thinking how much of a difference it was making to the relative recovery in Europe and the U.S. The fact that Europe isn't thinking about that kind of big stimulus package that the Biden administration has in its sights. And it is going to mean that maybe the Eurozone economy gets back to just its pre-COVID level, pre-pandemic level, towards the end or the second half of next year, which would be a full year after the U.S.
That was Stephanie Flanders of Bloomberg. And it's not just Europe that's looking toward reopening. Vaccinations are proceeding in the United States, even though there remain some bumps in the road, as we heard from Katherine Baicker, Dean of the Harris School of Public Policy at the University of Chicago.
What we're seeing now is the result of the last year's worth of mixed messages about the efficacy of a vaccine and the importance of getting vaccinated, and also a disconnect between what's happening in a central government coordinated push versus what's being left to the states and the localities. That last mile of the vaccine is very hard for a lot of localities to manage, and having more centralized resources up and running might be really helpful in making sure that there's accessibility to the vaccine across the country.
Well, that's my question. Is there anything we can do about it at this point?
Well, I think it starts with more consistent messaging, starting at the top of the government and all the way down to local leaders about the safety and the efficacy of the vaccine. And there's a little bit of a challenge in that we're telling people to continue to be careful after getting vaccinated, which is prudent on one level, but on the other hand, might suggest to people that it's not so important that they get vaccinated, which of course it is. So we need that consistent messaging across all levels of the government. And then we need to use the systems that are already in place to help deliver vaccines like the flu every year. Make sure that we're using all of those outlets to get the vaccine to people through hospitals, through drugstores, through employers. We need every mechanism available to us.
That was Dean Katherine Baicker of the University of Chicago's Harris School of Public Policy. Coming up, looking for yield in all the right places. We talk with Amy Schulman of Polaris Partners about the promise of biotech.
Biotech is a long game. There are a lot of failures, but the successes are spectacular.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Markets are pretty much enthusiastic about everything these days, from equities to commodities to Bitcoin. But in a world where everything seems fully valued, where do you go to beat the norm? Well, one of the places may be biotech. SoftBank certainly thinks so. The Japanese firm is said to expand its investments in biotech, including a $312 million stake in a US-based DNA sequencing company. And we talked with one of the people who knows that world the best, Amy Schulman of Polaris Partners, about where there's money to be made. Maybe not over the short term, but over the long.
Biotech is a long game. Drug development is expensive. It's risky. It takes, on average 10 years. There are a lot of failures, but the successes are spectacular. They're meaningful in terms of human health, and they get appropriately rewarded when they work.
So if you have patient capital, that's a possible destination of patient capital, but you just said it's risky. How do you know that it's going to make money over the long term? You could lose all the money, couldn't you?
Absolutely. Anybody who tells you you can't lose money in biotech would be kidding you. But what you try and do is invest in portfolios. So as a venture capitalist, I never invest in single asset plays because there's very little that I can do to influence the outcome of that, turning over the card, and a lot of promising things fail in phase 3. But if you're building a platform, whether it's in vaccine development and you're looking at, therapeutic vaccines or prophylactic vaccines, or if you're looking at a modality that can work for neuropsychiatric and oncology, you try and invest in things that can be applied to different diseases, and maybe that can be applied in different ways, like a small molecule and a monoclonal antibody. Those are far more diversified within one thing. And of course, a fund is a diversified approach to venture capital investing as well.
So you just mentioned vaccines, which is on everyone's mind right now. How much has the coronavirus and the really remarkably rapid development of vaccines, how much has that changed your business? Is everybody rushing to get into your business now?
I think it's had an impact in two distinct ways. One is that it has reminded all of us how important science is, how much it matters in terms of the trajectory of human life and in terms of reaching out to people all across the economic and political spectrums in order to change what has become, one of the most feared problems of our day. And for a long time, pharmaceuticals and even biotechs were seen as something kind of abstract. So in that sense, I think we've had a resurgence of interest in science mattering to all of our lives. It's also, for sure, affected the types of investments we make. If you look at the way in which our lives have changed and the rise in telemedicine, this was something that was on the margins of the changes that were happening, and they're now in the forefront. And so I think certainly in our portfolio and in many portfolios, the investments that we've made prior to the pandemic in telehealth and telemedicine have shown a remarkable and we think durable growth.
Warren Buffett in the past has said he doesn't want to invest in a company he can't understand, and that's why he stayed out of tech for a long time, although he did come around to Apple sooner or later. Is that true in biotech as well? I mean, how much science do you need as an investor to assess who's got the good science and who doesn't?
That's a really tough question, because I think you certainly need to understand the science. On the other hand, understanding the science doesn't necessarily tell you what's going to win or doesn't. And so understanding the science is a necessary but not sufficient. You have to understand the commercial marketplace, the team that you're building, the regulatory landscape, and you have to be willing to believe that what you're investing in is not an incremental change, because incremental changes are the way of the past in terms of venture investing.
So looking forward, you mentioned telehealth as really being an opportunity here. What are the areas that you think over the next, as I say, 5, 10, 15 years, you think are reasonably good bets, at least as a category in biotech?
Yeah, well, reasonably good bets. Maybe I can just reframe that question and tell you the things that I'm particularly interested in right now are things in the mental health space, given the tremendous challenges, the need that far outstrips the demand, and the destigmatization of mental health that is happening around the world. And I think this is something that from a reimbursement model, from an outcomes model, is really important. Of course, everybody looks at an aging population. And so that means that all of the diseases that disproportionately affect the aging are profoundly at the top of mind, whether it's Parkinson's or Alzheimer's or any of those sorts of conditions. And then you couldn't get out of a biotech conversation these days without talking about the intersection between true artificial intelligence and adaptive machine learning and drug discovery. So I think those are things that are on everybody's mind.
That was Amy Schulman of Polaris Partners. Finally, one more thought. Finally, falling in love with our friendly retailer. Let's face it, we've all been cooped up for far too long. And virtual cocktails, well, they just don't cut it any longer. We need to connect. And some traditional bricks and mortars retailers are trying to do just that. Take the second largest clothing retailer in the world, fast fashion icon H&M. Its profits plummeted when it had to close 80% of its stores. But now it's trying to come back, not just online, but by turning its stores into something you just can't get on the internet. Things like getting your clothes mended, and renting a party dress, and doing your hair.
People are underestimating the importance and power of stores as we look forward.
It's all about engaging the customer, and for that, no one comes close to H-E-B, the grocery chain in Texas named with the initials of its founder. When the winter storm last week came and took out power to millions of Texans, H-E-B was there, making sure you could get the essentials morning, noon, and night. Everything from drinking water to a cake for your son's birthday. And in doing so, H-E-B cemented even further its relationship to the communities that it serves, leading people, according to the New York Times, to buy t-shirts saying H-E-B for president, or a woman to post a video on TikTok saying she wished for a boyfriend like H-E-B, one that's always there, gives her flowers, and feeds her. So as we emerge from a year of isolation, it may not just be our friends and our families we embrace, it may include our stores. We may not want them to be our president or our boyfriend, but it wouldn't hurt to come to rely on them in ways we've never thought of before. That does it for this episode of Wall Street Week. I'm David Westin. See you next week.